Okay, brilliant. Now that we have comprehensively gone through support and resistance, swing high and lows, as well as comprehensively investigating candlestick analysis, we wanted to highlight a very special price action trading strategy that really is similar or the same to a candle strategy, but is still known as a Western strategy. So it's the perfect time to discuss it. It can be really reliable and has to do with all those spikes that you sometimes see. Remember what price action is? It's the process of using the price chart itself with minimal indicators to assist in trading decisions. The Pinbar formation is actually a price reversal pattern consisting of 3 bars. Once familiarized with Pinbar formation, it is apparent from looking at any price chart just how useful this pattern can be. Let's go over exactly what a Pinbar formation is and how you can take advantage of the Pinbar strategy in the context of the Forex market. Traditionally, the Pinbar formation was observed and named using a bar chart. However, we will first discuss it as a bar chart and then convert it to a candle chart and discuss the type of candle formations associated with the Pinbar strategy. The actual pin bar itself is the middle bar of a 3-bar formation that can be found on any stripped down or naked bar chart or candlestick chart. The pin bar itself is commonly known as the nose, which we will explain shortly. And the bar to the left is known as the left eye, whereas the bar to the right is known as the right eye.
The following characteristics or rules should apply to a pin bar formation. Number 1. The left eye should be a bar up for the bearish pin bar pattern or a bar down for the bullish pattern. Number 2. The nose bar should preferably be open and closed inside the left eye, but its high or low for the bullish setup should protrude much farther than the left eye's high or low, generally twice the size of the body of the candle. Both the nose bars open and close should be located in the bottom, which is top for the bullish setup, a quarter of the bar. Generally, the trade is initiated on the right eye or at the close of the right eye. An additional condition for the good pattern setup is the strong support resistance level formed either behind the eyes or near the point of the nose. The stronger the support resistance levels you incorporate into this pattern, the more accurate it will be. Candlestick pin bar formations. Now let's see what a pin bar would look like as a candle formation on a candle chart as opposed to a bar chart, as we are more familiar with this. Candlestick pin bar formations are exactly the same as standard bar chart pin bar formations, except the terminology is a little different, but now that we have gone through the candlestick pattern, it should make a whole lot of sense. However, they should be traded the same way. A bearish reversal or top reversal pin bar formation can be formed with either long-wicked dojis, long-wicked gravestones, or a shooting star, which are essentially all very similar in their appearance, but can all form the nose of the pin bar. A bullish reversal or bottom reversal pin bar formation can be formed with a long-wicked hammer, long-wicked doji, or long-wicked dragonfly doji as the nose. Candlestick pin bar candle formations naturally also display the same characteristics that we listed above for standard bar chart pin bar formations, as essentially they are the same pattern. Just one is described in Western technical terms, while the other is in Eastern technical terms. Naturally, we use candlesticks as our preferred chart type, so our examples will be taught as such. Example of bearish pin bar formations using a single chart. Here is a daily chart of dollar-yen on a single hourly chart. We can see numerous bullish formation pin bars that are very well defined and worked out very nicely. Notice how all 3 of these examples have the body close that is quite low and that all the tails of the nose are very long. Of course, it's easy to see in hindsight, but as with any candle formation, it's critical to wait for the closes in order to see the true picture of pattern. You will soon see that there is often a lot of trading activity just before a candle closes, which can dramatically change its formation. For example, on an hourly close, the last 10 minutes or so can have a lot of activity to essentially fight out for the close. Examples of a bullish pin bar formations in action. Here is an example of a pound-dollar pin bar formation. We can specifically choose this pin bar just to highlight to you that you can see that even after aggressive moves like this strong bearish impulse move down, prices create a bullish pin bar and essentially was a precursor to prices battling to break any lower with an expectation of reversing the trend back upward. But importantly note how prices still took quite a while to ensure that prices could not go any lower. So there was a considerable fight until finally prices broke out of the narrow range to break back up again in a consistent upward impulse trend. So the moral of the story is that even though theoretically pin bars of prices move up or down straight away from the formation, in reality this is not always the case. But you should still pay attention to what the signal the pin bar is giving you.
How to trade a pin bar formation. To effectively trade the pin bar formation, you need to first make sure it is well defined, as we have discussed in our characteristics. Not all pin bar formations are created equal. It pays to only take the pin bar formations that meet the described or are very close to the described characteristics. Alright, so next, try to take only pin bars that are displaying confluence with another signal. Generally, pin bars taken with dominant trend confluence are the most accurate. However, there are many profitable pin bars that actually occur in range-bound markets or at major upmarket turning points. As we progress our technical knowledge, you will see how we will combine the pin bar pattern with strong support and resistance levels, pivot point or trend lines, Fibonacci retracement levels, and moving averages. The pin bar formation is of course a reversal setup and hence can be seen as part of a range trading type strategy where you're buying low or selling high. So for a bearish pin bar formation, we will sell on a break of the low of the pin bar and place a stop loss a few pips above the tail of the pin bar. On a bullish pin bar formation, we will buy on a break of the high of the pin bar and set our stop loss a few pips below the low of the tail of the pin bar. So we now know that the pin bar, which by the way is short for Pinocchio bar, get it? Pinocchio? Is a candlestick setup that clues price action traders into potential reversals in the market. Essentially, when traders see elongated wicks standing out from the price action, they can look for the momentum that created the long wick to continue by looking for a reversal. So, if a trader sees a long wick standing out below the price action, they can go long. If a trader sees a long wick standing out above the price action, they may want to go short. Much like Pinocchio's nose, the elongated wick of a pin bar can tell us that a lie is being told. But not all long wicks are created equal. As a matter of fact, many of these long wicks will not be pin bars at all. But that does not mean that they can't be used by price action traders. It is therefore critical to understand fake pin bars or long wicks that do not stick out from price action.
What separates a pin bar from a fake pin bar? The first thing we want to get comfortable with when looking for pin bars or fake pin bars is what it is that we are looking to take part in by trading that setup. Let's take a closer look at an example of a legitimate pin bar this time, shown on a daily dollar-franc chart below. From this graph, we can see what makes the pin bar attractive is the fact that price has reversed enough to leave a long wick exposed underneath price action, all taking place during the pin bar candle. The difference between a pin bar and a fake pin bar is therefore determined by recent price action. So if the long wick sticks out from recent prices as we have just seen, that is a pin bar. This is the lie that the market may be telling us, that a movement to a previously untested level has brought a new group of buyers, or sellers in the case of a bearish pin bar. However, if the long wick does not stick out from previous price action, they are not a genuine pin bar, but rather we call these fake pin bars. So as you can see here, the fake pin bar doesn't quite stick out from previous and recent price action. But with the genuine pin bar leaving a long wick above the candle, traders could look to open a short position to take part in the momentum that created the long wick in the first place. However, as you can see from the setup, that would not have worked out too well, as we can see prices continued upwards. So trading fake pin bars requires additional analysis, as the signal of a short-term reversal in prices may not be as consistent as that of a genuine pin bar.
But what if a long wick isn't sitting outside of the recent price action? This might mean that the potential for a reversal on fake pin bars could be smaller than that of genuine pin bars. But that doesn't mean that price action traders can't use this information to our advantage. We merely have to qualify which fake pin bars might be favorable and which are not. We can do this by looking at the trend of the currency pair and attempting to enter only in the direction of the longer-term trend. To do this, we would want to scroll out on our charts and analyze more previous prices than if we are trading a genuine pin bar. And the reason for this is so that we can get a better assessment of the long-term trend and look to only trade in that direction. In the following example, we can see that after prices have established an uptrend by creating a series of higher highs and higher lows, a fast price movement on the downside was corrected before the candle had completed, leaving the long wick circled here. We then see a fake pin bar, which could not be traded as it is in the opposite direction of the previous strong trend. However, we then see another pin bar which is in the direction of the trend, and therefore traders can look to trade this fake pin bar by going long after this candle has formed, placing a stop slightly below the low of the fake pin bar wick. That way, if price happens to reverse against us and move down while we are in a long position, we can exit the position if a lower price is formed below the bottom of the fake pin bar wick. Alright, so here's a final example with a downward trending market, and the difference between staying away from fake pin bars that are against the trade while still having the ability to trade a fake pin bar in the direction of the bearish trend. So in summary, the pin bar formation can be a very valuable tool in your arsenal of forex trading strategies. The best pin bar strategies occur with the confluence of signals such as support and resistance levels, dominant trend confirmation, and other confirming signals. Look for well-formed pin bar setups that meet all the characteristics listed in this video, and don't take any that you don't feel particularly confident about. Pin bars work on all time frames, but are especially powerful on the hourly, 4-hourly, daily, and weekly charts. Go through some historical charts and practice looking to see how historical pin bars have formed, and you will be more prepared for when they do appear in live trading. See ya!